Okay, let's get started here. I think as you have noticed that we replaced the lecture 5 with this combination of 5, 6 and 7. This kind of brings most of the algorithms that I have in mind together, and this mainly focuses on looking at one single asset. Then it also looks at pairs trading. We'll also cover a little bit of co-integration where you can look at multiple stocks together. And it doesn't bring in other information like putting volume, volatility, all those things together, which we will take up after we finish this set of lectures here. Okay. So I also want to mention that the second assignment has been posted, so you should start working on them. It's not as complex or cluttered as the first one. It's very straightforward assignment. And I'm also looking for ideas here because this is a data set that I've worked with extensively before, and we're trying to develop some strategies based on this data set. So there's some new ideas I would like to learn from you guys. Okay? And there are going to be 3 speakers coming. One next week, July 22nd, Wednesday. Howard Sheikh from Tower Capital will be here. Howard was my student. He's also a graduate from this campus. And the second person is Peter Layton. He will be here on July 27th. And on Wednesday, July 29th, Maxence Hardy from JP Morgan Chase will be here.
Who's that again?
Maxence Hardy. He's from JPMC. He's the one who is heading the linear quantitative research group. So you'll be here. And after that, I think during that week, I would also try to make up at least one class that week because I won't be here last week of classes. Okay. And before I get started, do you have any questions? Any questions? Okay. And I think probably I think the first homework would be graded, would be returned to you before the second homework is due, so that you can see what is expected from you. Okay. So many of these things we covered last time. Towards the end, I think this is the part that I would like you to start with. Okay. And this is an interesting paper. It's an old paper, 1966 paper, but nevertheless it drives the point that random walk with zero or positive drift, no rule will consistently outperform buy and hold strategy. Okay. So essentially what they mean by that is no single rule would outperform. So I think the very idea of algorithmic trading is that anything that deviates from the expected rules, we want to exploit that. That's the main idea. Okay. So essentially looking for anomalies that occur, anomalies that are supposed to be deviating from the expected pattern, and then exploit that information to make money. That's the main idea here. Okay. And there is also, I think, this idea of no obvious relationship between the magnitude of serial correlation and expected profits of a mechanical trading rule. You'll see that this is a sort of broad statement that was made in that paper, but actually there is a connection between serial correlation and magnitude, which will come out when I do the trading experiment that I'm going to show you. Okay. So there are some useful information that I would like you to keep in mind. Prices tend to trend or have a momentum, or prices have a tendency to mean revert. Okay. So the idea, I think, is that there are 2 ideas. One is that if the prices go up, generally they have a tendency to go up. That's a momentum idea. Okay. But in fact, when we use the momentum in the financial the way financial literature deals with that is that momentum is usually taken as a group concept rather than individual stock concept. Okay. Whereas mean reversion is a fairly straightforward concept, that is that prices are supposed to fluctuate around certain mean, and whenever it deviates too much from that mean, you can make some sort of trade and then it's supposed to come back to where it was before. That's the idea behind it. Okay. And the concept that's going to help us to exploit this fact is that stationarity concept. So stationary process, as we know, is never going to deviate from its mean, and because of the finite variance. Okay. But if you have a non-stationary process, we know the variance need not be finite, so that concept doesn't apply. Usually for non-stationary processes, we are going to find some sort of differencing process that will make it stationary, so that we can use again this concept of mean reversion. Okay, so if you look at this AR1 process, you can show that the mean reverts around that quantity mu, which is the average of xt, which is given by the constant term alpha divided by 1 minus pi. As you can see that if pi goes to 1, that mu constant doesn't exist, so it becomes difficult to use that concept. Okay, so if the process is stationary, you can show that the rate of mean reversion is given by this quantity here, and you can see that if pi is very close to 0, this part will die down very fast. The mean reversion occurs very quickly, and if pi is close to 1, it will take long time for it to die down, so the mean reversion takes forever. Okay, so we are going to take a simple test here. So we are going to generate data from the AR1 model, and we want to come up with some sort of rule here. We are going to take a sample path. We are going to use here, just for illustration, simulation price data, and we are going to define entry as some sort of if and then statement, because if the prices deviate from certain number, then we are going to make a trade and or buy or sell. So define a trade exit either as a success or a stop loss. Okay, I think one thing I want to mention here is that with the high frequency trading, most of the trading seems to start in the morning, end in the day. They close the position by end of the day. Okay, and the stop loss is a very important concept, because you not only want to maximize profit, but also you want to minimize your losses. Okay, so whenever you see that there is a big drop in profit, you want to stop. Okay, so we are going to use the simple rule. We are going to update the position. We are going to keep track of the cash, how much money we have, and we are going to update market to market risk profit and loss equation. And one of the things I want to mention here is that the same P&L equation, sometimes they call it as equity curve. Okay, essentially it looks at how much money you are making over time. Okay, so to that extent, I want to mention few financial ratios people use in practice, and these are the various other ratios people look at in practice. So let me give you that. Okay. By the way, I think many of these ratios are listed in the book manuscript that I posted. If you look at the last page, I think it's given there. Okay. So the famous one is the Sharpe ratio. Okay. So it looks at the average return on the asset, RIT, minus RF divided by standard deviation sigma I. Okay. So if you define this return as a log difference in the log prices, it is just nothing but the starting return and the final return, the difference between the two. It's very easy to calculate. Okay. And then the second one, I think, is based upon the traditional CAPM model. RIT minus risk-free rate is given as alpha I plus beta I times RMT minus RF plus. So that is the traditional CAPM model that's used. So they also look at trainer ratio. Okay. So this is given as the numerator, which is sometimes called as risk premium, minus RF divided by beta I. Okay. So what does beta I signify? Beta I is supposed to be how much risk you are taking for the excess return. Okay. So so that is the coefficient they use. Okay. There is also another one people look at. This is information ratio. Information ratio. So this is given as the constant alpha I divided by the standard deviation of the error term. Okay. This is information ratio. So under CAPM, you should expect alpha I to be 0. But I think, if you look at the models, people boast about alpha strategies, mostly showing that how much excess money they can make after adjusting for the riskiness of the asset. Okay. So these are few things I've seen. Let me give you one more that's used here. This is known as Certino ratio. So this is given broadly as expected value of this average return minus some sort of target value. This I'm going to write it as target number. Here we are targeting the risk-free rate as the target rate, but you can put anything you want here. And they also look at downside risk of the return. All right. So essentially keep track of how much it goes down. When it goes down, only look at only the negative side of this. Okay. So this is nothing but downside volatility. Keep in mind that when the prices go down, they tend to go down much faster than they go up. So risking for the downside information is accounted here. Okay. And then there is also the last one. I'm sure there are many more here. These are the ones I am familiar with. I have worked with them. Colmar ratio, which is given as compounded annual rate of return. Annual rate of return divided by maximum drawdown. Maximum drawdown. Okay. This is the another measure people use. Okay. I like this measure because of, in the end what matters is that what is the rate of return that you make, right? So if you have any duration, I think you should be able to compute exactly like what we do here, return the current period minus return to begin with, and then not return the price differences, and then you can also look at the maximum drawdown. Okay. So for this particular course, I think, I tend to focus mostly on Sharpe ratio, but I would like you to think about keeping track of investment over time to see whether generally the investment is going up or going down, because you can compare that graph with buy and hold strategy, just looking at how the prices change over time. Yeah.
You mentioned that they use this in practice, but do they use it only for portfolio evaluation at the end, or just to make some kind of decisions when to buy a stock or to sell a stock?
Actually, they use it after, certain period. They evaluate how the investment is doing, and then they look at whether they have to make any changes. Okay. Usually, I think to make changes, you need to tinker with it as the trading occurs. Most of the time I've seen we adopt a strategy. When we do the back testing, we adopt the strategy and look at how well it has done using one of these ratios.
Do you also use these ratios to determine the stop loss?
Yeah, I think the maximum drawdown, I think you need to define how much loss you can take. That has to be a separate constraint. Okay. Okay. So here I think, up to this point, I think this is fairly easy. But the most important thing I want you to keep in mind is this accounting for transaction cost. Okay? Because most of the strategies tend to look pretty good on the paper until you take into account the transaction cost. Because each time you buy and sell, you have to incur some standard costs like brokerage fee and other, exchange fees and so on. But those are all very standard fees. But there is also market impact, which is nothing but once you enter the market, it's possible the market will go against you. That estimate is fairly not easy. Okay? But for this particular calculation, we are going to assume that we have this 10 basis points. Okay, so essentially if you look at this, this is going to be the transaction cost, and x is the price, qi minus 1 is the position that you have taken. So even if you buy or sell, you just have to incur the transaction cost that comes in here, and then this is the updating of the cash. Okay, so the reason I want to define this way is that to show under various conditions for the autoregressive model how things change. Okay, so just to see that we are going to simulate an AR1 process with those parameters that we talked about, mu, pi, and sigma, and then we are going to follow this trade entry here. Before I set out this experiment here, I want to briefly mention what is the model that we have seen for price from last 3 weeks of lecture. Was that the prices are supposed to follow generally random walk model. So if we put a structure on this, P of t is equal to say alpha plus pi times P of t minus 1 plus say epsilon t. We all know that if the process is purely random walk process, alpha is supposed to be 0 and pi is equal to 1, right? That's the expected model that we are going to see. So we are going to see how much it deviates from, if you deviate from that ideal values, how much money you can make. Okay, so here I think it's a simple trade entry, that is you are going to buy when this ratio xt minus mu over sigma x, which is nothing but just the normalized xt, if it is less than minus 1, when sigma x is given by that quantity there, and we are going to sell it when that ratio is greater than 1. Okay, and the reason why we set this up 1 and minus 1 is that at least you can see some trading traits that occur. Okay, we all know that if xt is purely random process, completely random, then we know that how much percentage is covered by minus 1 to 1 limit, right? It's about 68% are covered. Okay, here we are using autoregressive model, which means that xt has some memory, and that's going to change the trading behavior. We also have the trade exit. If the ratio is less than 0.5, we'll say success and quit, and then if the ratio exceeds 1.5, we are going to say we'll exit the trade exit because the loss is mounting. Okay, so this score is called S score, and we want to see what is the profitability and how many trades you can do, and we are going to examine how does it depend on the parameters of mu, pi, and sigma. Okay, so keep in mind that whenever we are looking at mu, pi, and sigma, the basic numbers that we want to look for are the alpha is equal to 0 and pi is equal to 1. Okay, so alpha is equal to 0 means that mean is going to be 0, right? And pi is close to 1 means that mean is going to be it's going to be undefined. Okay. Yeah. So these are the R code that goes with this experiment is also posted on the coursework. You should be able to see when pi is 0.95, the price wanders off for a long time. Before I do that, let me ask you this. What kind of strategy is this? Is it a contrarian strategy or momentum strategy? On the face of how the rules are defined, tell me whether it's a contrarian strategy or momentum strategy. Is it? Mean reverse, a contrarian strategy, right? Buy low, sell high. That's what we are going to use. Okay. So this is the process, AR1 process with phi is equal to 0.95 and sigma is 0.05, that is sort of set, and mean is equal to 10, that is covered. Okay. So if you look at it, how many trades occur? There are 16 trades that occur here, and you can see that so that is the actual data, and then I given the limits. The red line is supposed to give you the limits. Red lines are the trade exit rules and blue lines are supposed to be the trading rules. So if you look at this profit and loss function, can you see that it's very uneven? It goes up and down, okay? And the number of trades are supposed to be 16 trades when pi is 0.95, okay? This is the actual process that we are looking at. When pi is 0.9, all the other parameters are the same. You can see the number of trades that occur is supposed to be 36. You can see that this P&L looks better than the other P&L, right? Even a small difference in the pi values, okay? So this is supposed to be pi is 0.5, and you can see this P&L has not too many downside risk. It keeps going, okay? And this is pi is equal to 0. That's what you see. The number of trades is equal to 0.96. This pi minus 0.5, I think, that's just I put in there. It doesn't really happen in practice. Okay, the key thing that I want you to keep in mind is the other three situation, pi is equal to 0 is 0.96 trades. Okay, more realistically, which graph seems to match the real life data? Pi is 0.95 or pi is equal to 0. So if you look at the pi is equal to 0.95 is closer to pi is equal to 1, right? So that is a more realistic situation. So if you look at the number of trades that occur during this duration, how many trades were possible? Only 16 trades are possible. Okay, only 16 times you can trade during the period. I think we looked at 250 days, 52 days of trading. Okay, okay. If I summarize this information, so this is what we have. Okay, we try to repeat the experiment 100 times, and we do the calculations based on average early return, annual return, and standard deviation of the P&L. If you go through this, I think the key part that I want you to keep in mind is just comparing pi is equal to 0.95, which is more realistic situation, with pi is equal to 0. Okay, so if you compare that, you can see the expected return is only 4%. Can you see that? 0.0434, and the Sharpe ratio is only 1.237, which is good still, and the expected number of trades is 21.7, right? About 20 trades, that's all you can make. Okay, so if you look at the last pi is equal to 0, you can make large number of trades. Okay, so the question I want to ask you is that if reality tells us that we should restrict pi is equal to 1, why do we do the other experiment here? What is the point of other experiment here? Anyone? The reason we did this was that if you look at generally the low frequency data, you should see that non-stationarity holds. And if you look at the higher frequency data in a short duration, generally I think stationarity seems to hold. If that is the case, the actual trading occurs during stationary periods, actual decisions occur during non-stationary periods. You can balance between the two. That's the reason we showed that for various values of pi, how trades are possible. Okay, so generally this is what I just summarizing here. So decreasing pi makes a strategy looks more profitable, which is not true in practice, and increasing pi is probably the more useful one. And we have included transaction cost. I think this line is not correct. So in practice, we don't know the parameters pi and mu in advance, so you need to estimate them. So the model might be misspecified because the mean itself might be changing over time because of the non-stationary process. Okay? Nevertheless, the main point of this exercise is that studying the stickiness of the price is all very important factor that goes into the decision here. Okay? Ideally, what I could have done was to see if I buy and hold, how does the equity curve look compared to this graph here. If that is the case, you don't have to worry about developing any trading strategies at all. Okay? Okay. Any question on this? Any question on this? Okay. So let me show you. I think this is probably one of the very first rules. This is known as filter rule. So the main idea behind the filter rule is that if the closing price goes up by a certain percentage, right, buy and hold until the price moves down at least X percentage. Okay. So on the face of it, what kind of rule is that? It's a contrarian rule or the momentum rule? It's a momentum rule, right? So that's what they've done. And then, there are some other additional constraints you can put. Maintain the short position until the price rises at least X%, and then moves less than X% either direction or ignored. Okay. So if you go through this, you can see this is a very simple rule to implement. And the first two papers by Alexander came in, pretty nice journals and very easy to read, very easy to follow. Okay. And the reason why I think these initial papers were very successful was that you can show that if the price moved up X%, it's likely to move up more than X% before it moves down to X%. So that shows the random walk is not upheld by the data. Okay. And so I think there are few bias in the results, but I think the most important thing that I want to go through is the last line here. Okay. And initial profitability of this rule was pretty high, but I think Farmer and Bloom have shown that after you adjust for dividends and commissions, profits are much lower. I think the last line is interesting because largest profits under the filter rule are those of the broker. Yeah.
What do you mean by after adjusting for dividends?
I think sometimes these stocks give dividends, right? Yeah. So which means that's an additional income, right? So if you take that out, I think there was not much coming out of the profit. Okay. So I think that's I think this kind of telling because you need to really worry about the transaction cost here. Okay. So that is the most important part of it. Okay. I think the next set of rules I think that are quite popular are the moving average rules. Okay. I think this is if you look at the moving average application in time series, the origins are mostly in macroeconomic modeling, where I think the macroeconomic data generally tend to move very slowly, right? So computing moving average was the easiest thing to see whether there is a long-term impact, is the price is generally going up or coming down. Okay? So all these strategies we are going to call it as trending strategies. Just look for the trend, overall trend, where the series are going. Okay? And just compute the moving average, and if the price is less than the moving average, buy. If the price is greater than moving average, sell. Okay, simple rule. Okay? So what is the important factor that one has to decide in computing moving average? Deciding the length of the window, right? That's what is important. Okay. So if you are using daily data, I have seen industry people use 22 days of trading. M is equal to 22. That seems to be the common thing people use. Okay. So what is the drawback of using moving average? Moving average are supposed to capture the long-term trend, right? So it's not going to react to short-term bumps very quickly. It will take some time to catch up. Okay, so moving averages tend to be fairly slow averages. Okay, so for that reason, you have to be very careful how you use moving average. And generally, I think depends on what kind of moving average you have. For instance, if you have a non-stationary process, and does the moving average work? What is what is the characteristic of non-stationary process? They may be going up for some time and then it come down quite quick, okay? So in the case of non-stationary process, the main problem is that predicting the turning points, how they change the direction, okay? That's the main issue, okay? So, so I think in addition to this, I think we could also look at exponential weighted average, okay? And exponential weighted average gives you more importance to the recent data, right, and keeps moving. And if you look at your notes, I think I mentioned that there is a close connection between exponential weighted average and the ARMA models that we talked about, okay? So if you look at the notes, you'll see that the connection is that exponential weighted average, we said, is equivalent to ARIMA 0, 1, 1 model, okay? But you have to be careful here. If the process is non-stationary, sometimes you may get the moving average value can be greater than 1, so which means the model is not quite easily invertible. So, but nevertheless, I think I would always tend to use the ARIMA 0, 1, 1 to check what kind of numbers I get. If the number turns out to be greater than 1, I lower it down less than 1 and try to use the exponential weighted average, okay? Okay. The second one, I think, which is popular in the industry is that Bollinger Band, okay? If you go to Yahoo Finance, you'll see that this is already incorporated in their pictures, okay? Bollinger Band. What exactly does the Bollinger Band do? What is the difference between the simple moving average rule and this rule? In the Bollinger Band, it's pretty much like what we use in quality control, industry quality control. So it takes into account the variance too, right? That's the main part of it. The second one is that if you look at the average, how it computes here, you can see that that average is given as some sort of exponentially weighted moving average. Can you see that? So if you look at the P hat, P hem, you'll see is given as sum of m minus I P of T minus I 1 over sum of I, okay? So essentially what it does is you can see it gives you more importance to the recent observation as you go along. It's going to give less importance, okay? So it computes the average, it computes the standard deviation based on this average that you have. So it creates bands that says that if the price is going to be higher than the upper band, you sell. If the price is less than the lower band, you are going to buy, okay? So that is the rule that we are going to use, okay? So the main point of this was that to bring in this additional information on standard deviation. That's the main thing that comes up here, okay? So that is the rule, okay? I want to show you one example. Maybe I'll finish this and then come back here, okay? Okay. Okay. The other one that people use in practice is this moving average oscillator, okay? And but let me show you. I think I want to see whether I have this Bollinger Band. I have posted the R code for computing the Bollinger Band on coursework site, so you should be able to use that to do your homework assignment too. So let me Royal Dutch Band. So we're going to see two stocks later in the context of pairs trading. One is the Royal Dutch, the other is Shell, and both are supposed to be coming from the same parent company, and they're supposed to behave similarly. But here I'm just going to show you the Royal Dutch here, and just want to show you the trading signal that comes up. So you can see that is the closing price. I have data from daily data from 1989 onwards. So I compute the average P bar and then P hat the way I've defined there. Compute the standard deviation, gives you the upper and lower bounds. And if I follow the rule that I mentioned, if it is about 2 standard deviation, we are going to sell. If it is less than 2 standard deviation, we are going to buy. Okay. So the last column gives you the trade signals. Okay. So I'm going to try to plot this one. I think last time I tried to plot, the numbers were so close it was not coming out well. But let me show you this. Okay. Hope this So I have this data here. I just want to first plot this closing price so that you can see if the price is stationary or not. So it should not be stationary, but just to check it out. So I'm going to have this closing price. The timestamp is the date here. So that's a price that you see. And see, the price is generally non-stationary, right? It's going up, and then there is a lot of oscillation here. Okay. So if I plot this, so let me do this. I'm going to plot this upper bound and lower bound on the same graph. You can do it same here. Okay. So I'm going to use this upper bound and lower bound, and also closing price, and time scale is the date. So multiple graphs I'm going to put overlay on top of each other so that you can see the connection. So it's sort of difficult to see. That's a graph that you see. Okay. It has to be done on a moving average, moving window basis, right? Here I took, I think M is equal to 22 days, and then try to compute this, and you can see that the dark graph is supposed to be the upper bound, and the green graph is the close here. And whenever the green graph is going to be less than the red line, we are going to buy. If it's greater than that, we are going to sell. It's very difficult to see this graph, but there is a trading signal that takes place. So I'm going to try to see if I can plot it together. I think last time when I tried, I think it was not that easy to see these things. So let's see with the groups here. Closing price. If it doesn't work out now, I'll try to bring it next time around. Trade signal. So that's how it is, I think. Sorry, it's giving too many things here. So the closing price is given by the dark line, and then there is this. No, I think I'm going to abandon this. I'll come back to it later. I think this is too messy a graph to see. So essentially, if you plot it, you'll see that -1 is the entry, +1 is the exit strategies. Those things plotted on a different colors. You can see that usually it happens whenever this upper bound, whenever the price actually exceeds the upper bound, that's when you see it. Okay, so this is not ex post, it's ex ante. You have to think about how you want to draw this graph as you move along. Okay, so the strategy is actually backtesting strategy is actually real strategy. So you could make some money here. As I mentioned, this is the last column gives you the trading signals, and you can see that most of the time it says the exit, but there are sometimes it says the enter, but the number of signals are fairly small signals, small number of signals you get. Okay, so I'll try to get a better plot on this. I think I didn't get around working on it carefully. Okay, that's a Bollinger Band. Okay. So the second set of strategies, I think, is based upon this what we call as moving average oscillators. Okay, so you compute the short-term moving average. You also compute the long-term moving average. Okay, and essentially short-term moving average gives you the short-term trend. Long-term average gives the long-term trend. That's the idea here. Okay, so once you have them, you are going to say that upward break if the short-term moving average intersects below the long-term moving average, comes down, it goes up, the long-term moving average, and downward break is that when if it intersects above the short-term moving average intersects the long-term moving average, the above line. Okay, so these two are just expanding what I'm saying in English there. Okay, I don't think there is anything much to it. Okay, so what are the values of M and N people choose in practice? What are the values of M and N? Here I think you need to decide what should goes in short term, right? What you consider as short term, what you consider as long term, right? So usually I think the long term averages are still taken to be 22 days, and then M is generally taken to be last 5 days of transactions, last 1 week of transactions. Okay, so so I think those are the two numbers still being used, and you'll see that some of these financial software comes with this package. Automatically they decide. You can choose what the values of M and N are, but in practice I've noticed that N is taken to be 22, M is taken to be 5 days. Okay. Okay. This is another one that's quite popular. It's called relative strength index. Okay, and what is the main idea behind this relative strength index? Okay. So I want you to focus on U and D. Those are the two basic calculations that go here. What does U and what does D do? S is supposed to be the price, and I think I should change the notation. S is supposed to be the price. Okay, so what is U and what is D? Upside and downside, that's all. And it says that how many times it has gone up, price has gone up, how many times the price has gone down. So you look at the you look at this quantity here, R of ST, which is supposed to be the ratio of the two, and from here you can calculate this relative strength index, which is given by that quantity there. And essentially we are saying this RS of IT is greater than 70, it's supposed to be overbought, and if it is less than 30, it's supposed to be oversold. Okay, and let me give you a brief outline of this. Okay, because when I looked at this first time, the relative strength index, it is purely a descriptive measure. It doesn't have any model basis to it. Okay, just count how many times it has gone up, how many times it has come down. Look at the ratio of those two. Okay, and if it is greater than 70, we are saying it has to be, it's overbought, otherwise it's oversold. Okay, what is the connection between this and the random walk model that we started with? Okay, so I want to briefly give you an idea here. So let me, sorry. Before I do that, let me show you. There is a simple derivation that goes in here. So RS is supposed to be U over D. How many times it has gone up versus how many times it has gone down. Okay. I think there is an intermediate step people use in practice, that is so if you take this RSI, this is given as 100 times 1 minus 1 over 1 plus RS. So that is same as writing U over U plus D times 100. Okay. Okay. So how is it connected to the model that I am talking about? Suppose I have a random walk model with a small drift here, mu plus P of t minus 1 plus AT, where AT follows normal with mean 0, variance sigma square. Okay. So essentially this means that the written RT, which is PT minus 1, follows mu plus AT. So this sigma squared is nothing but the volatility measure. Volatility measure. Okay. So this indicates that RT follows normal distribution with mean mu and variance sigma square. Okay. So we are calculating some sort of, if we calculate the average return, can show that R bar T is supposed to be following normal distribution with mean mu, variance is sigma squared over n. Okay. So if you are looking for the average return over time to be positive, so looking for what is the probability that average return is greater than 0. If you go through this calculation, you can show that this is same as saying probability of AT is greater than minus mu. So if we standardize this quantity by sigma, this is same as saying 1 minus pi minus mu over sigma. Okay. So the RST quantity that we are talking about, generally you can show, you can evaluate RST. RSI is nothing but just a function of RS. So by this quantity here, 1 minus pi minus mu over sigma over pi f minus mu over sigma. Essentially, this gives you the odds ratio, right? What is the chance that it's, so if the mean is 0, we know that this is going to be 1/2 and 1/2, so it's going to be 1. So this essentially gives you the odds ratio. calculation. So when you say this RS of IT is greater than 70, it's sort of equivalent to saying IT greater than 70, you can show is equivalent to saying RST, which is this quantity here, is greater than 2.33. So essentially, if you have a normal distribution, you're saying that if the standardized quantity is greater than 2.33 standard deviation, you are going to say that it's overbought, come out of the market, and if it is less than the other quantity 30, you can similarly work out what that number is. You're going to say oversold and you want to buy. Okay, so I think these are there's a close connection between the models and this sort of descriptive statistics here. And if you have any questions, just you can derive through this yourself. I think you can show that there is a connection between the two. Okay, the reason I brought this in was to show you that so there is an attempt to extend this relative strength index to incorporate not only the change in price here, but also looking at how much volume that went with the change. Okay, how do you develop an index that you can say it's sort of a volume weighted relative strength index, right? You can see that this quantity is nothing but the amount of positive change, right? This gives you the amount of negative change. So there is a volume associated with that. So you can measure that volume weighted change too. Okay. So actually we tried to implement one version of it. I think you could show that this is how it comes up. Okay. So the basis of this is given by, I'm going to write here, this is another relative strength matrix they use, RSM they call it. Essentially they look at the total change in price delta x divided by only the absolute change in price delta x. Okay. And you can show that 1 plus R of SM is given as, just adding this 1 is going to give you sum of delta x plus sum of delta x divided by sum of delta x. So this is nothing but 2 times u divided by d plus u. Okay. Okay. So there's a connection between this and RSI. In fact, you can show that if you look at some of the initial publication on this topic, they follow this. This you can show this is same as writing 50 times 1 plus RSM. Okay. Forgot exact acronym for this. What does M signify? I'll remember that. I'll give it to you later. Okay. So the reason I mentioned this was that they tried to develop this from here. You can write this RSM where you weigh in the volume. So you could write it as V of I, that's a volume, delta X of I, that is the change in price, divided by sum of V of I times delta X of I. Okay. So you can go through the same calculations and define some sort of RSI index here. So they call it as RSM star. You can define RSI index, which is given as 100 times. I think you could define this as u star divided by u star plus d star. Okay. So where u star is nothing but just looking at only the positive volume associated with the positive changes, delta x of I plus sum of vi delta x of I. Okay. And the denominator is supposed to be the combination of ui and vi, ui and di. So d star plus u star is given as sum of vi delta x of I. Okay. So this is a indirect way of incorporating the volume into the model here, and usually I think the volume data is useful to improve the RSI index, but we found that the decisions we made based on incorporating volume generally was not adding much more value than just looking at RSI index itself. Okay, so it was not clear to me, but there is some work being done by various trading groups, how to incorporate this information. Okay, so that is the relative strength index. There is also qualitative patterns. I think this is another area there has been a lot of work done, and of late I have not seen much being said or written about them, so I am not sure how useful they are. So they use what we call as kernel regression. Okay, so what is the idea behind kernel regression? What's the idea behind kernel regression? Okay. So essentially you look at the plot of the price series, right, and you try to approximate the local pattern through a smooth graph just to see where this is going into the future. That's the main idea. Okay, so the paper to read is by Low and Wang paper. It's a very nice paper. So essentially if you look at this function here, they run some sort of kernel regression here. So ordinary regression, if you write down the equation the way you estimate the predicted value for that, you will see that it's weighted by average deviations from x deviations from the average. That's what roughly we do. Here I think it's going to look at how much you weigh around the points that you are interested in. Okay, so let me briefly show you the pictures that they have, and so the paper to read is by this Low, Mamayaski and Wang. I am not going to dwell too much on this because it's purely, these are the smoothing technique. This is how they do it. Okay, so if you look at this graph here, they run a smooth graph around that. This is a simulated data. There is actually actual data too. Let me show you that. So this is the sort of graph they have. So if you look at this graph, they identify number of patterns based on this graph. The one they call it as head and shoulders. Head and shoulders is like, this just shoulders and then head and then head. So essentially the pattern is supposed to repeat over time. Okay, that's the idea here. Okay, so the process of computing these things, you can see that's head and shoulders, and they also identify few other patterns here. So look at this, is supposed to be the inverse head and shoulders pattern. Okay, and this is the broadening top. You can see that that's a broadening top, and so on. Okay, all these things are based upon some sort of local smoothing of the graph. Okay, so I do have some problem in seeing pictures and making conclusions, because sometimes you tend to see what you want to see, So it has to be sort of combined with some sort of actual models if you want to see how it works. Okay, so for that reason, I'm not going to spend too much time on this. If anyone is interested, you should read through this paper here. Paper, I think it's when it was published, it's very well received, so you may want to take a look at it. So let me move on to the next topic here. Okay. So having said all these things, these variations of these rules are being currently implemented. The question, I think, is that can technical rules do better in the case of market microstructure application? Okay. So what is the difference between using this on a daily data and using it on the high frequency data? We know the high frequency data is going to exhibit lots of variation. That variation comes not because of having any information on the true information. It comes mainly because of market friction, right? How much of it to capture. Okay. So there is a set of rules that people have developed here. So essentially they call support level and resistance level. Remember that we briefly talked about this. The order book has two sides to it, right? One is the ask side, the other one is bid side, right? And the order book changes very rapidly, right? So you need to decide at some point when to enter, when to leave. So they built some sort of, pretty similar to what we did before. One is called support level. Support level is nothing but, if you look at it, it's a minimum bid. And then resistance level is the maximum ask. Essentially, they are looking at the best bid and best ask and how rapidly they are changing, right? So the idea being is that if you know if you know how fast the order book is changing, you can develop some simple rule here. They call it moving average indicator. Essentially, they're look at the moving average of the support level, essentially moving average of the bid level, and similarly moving average of the resistance level, and use these rules to decide whether you want to enter the market or exit the market. Okay, where the moving average of the support level is given by this quantity here, and moving average of the lower limit is given by the second quantity here. B is supposed to be exogenously decided. P is the quoted midpoint, should say midpoint price. Okay, so this is from my notes, I think this is what I have. Okay. Trying to see where I have this. This is based on one of the very recent papers. So if you look at it, I think you'll see that there is T minus W. So you need to look at the how many periods you want to go back to compute this, the best bid average and best ask average. Okay. So generally, I think they look at the following. So let me write here. W is generally taken to be the prior week. What is the best bid and best ask in the prior week? And when they calculate the averages, they look at 70 most recent observations. Okay. And the quantity B, which is supposed to be acting as a deciding point to enter or exit the market, generally taken to be, B is taken to be 3%. Okay. And they calculate the last half an hour interval. T is supposed to be 30-minute interval. Keep in mind that this is supposed to be changing so fast, and if you start worrying about every observation, there's going to be a lot of noise. So look at only 30-minute interval, sample them and see how it works. Okay. So they've shown that I think the profit levels is pretty good if you use this information. So I want to write a couple of more things before we. So let me write it and then I will explain this next class. Regress buy side limit orders. Limit order measures. On the support level measures. Support level measures. Similarly, regress sell side limit order measures on the resistance level. Levels. Okay. I think you need to subtract after subtracting midpoint of beta spread. Okay. So after subtracting the midpoint of beta spread. This is just to see whether the past support levels and past resistance level can give some information about the future. That's the idea behind it. Generally, they've shown that R squared is roughly 15%, which is pretty good in this kind of cases. So the moving average forecast tend to reveal, I think I have it in my notes that, relative position of the depth of the market. Okay, but I tend to use this order book data in a slightly different context. I look at the imbalance between the two sides. Okay, what is the imbalance? How do you measure imbalance? You can measure in terms of how far ask and bid prices are away from each other. You can also measure in terms of what is the volume associated with both the buy side and the sell side, and what is the ratio of that volume. Okay, and again, as I mentioned, all these calculations are going to be pretty difficult because the order book changes almost instantaneously. So you need to be very careful about how far you want to go in the order book. Okay, so one of the things you may want to ask Max when he comes here is to how they look at in industry. Okay, and last time I spoke to him, I think we were looking at one exchange's order book in depth, just going on both sides, and he told me that you're wasting your time because right now with multiple exchanges, people are looking at only the top of the order book in each exchange. There is no point in worrying about depth of an order book in one particular exchange. It doesn't add any value. So I think with multiple exchanges, I think these things are changing. You may want to focus mostly on the top 3 positions of each order book and see where the market is moving. Okay, so I think that's something that I want to do. So when we come back on Wednesday, I will look at least two items that I think we want to cover. One is this. We have seen so many versions of these technical rules, right? We saw moving average, resistance, relative strength index, and all that stuff. So you can combine them in many fashion. Last time I saw a paper that evaluated all the rules. came up with close to 8,000 rules, that combinations of these things you can consider. Okay, so there is a danger in using those rules blindly, because you might be overfitting, you may find significance that may not stand the test of the time. Okay, that's one possibility. And the second one I want to cover in deep depth is that if you have multiple rules, which one you would select? You know, what is the methodology behind it? And we are going to talk a little bit about boosting method that's been very popular here in this campus. And this second thing I want to cover would be the pairs trading, which is also quite popular. Okay, so look at your notes on co-integration before you come to class on Wednesday, because when I cover pairs trading, co-integration is going to play a role. Okay, I'll stop here. Yeah.